I want to make sure that I welcome our next panel and make sure that I write my reactions on the chat, which I've seen a lot of activity. So continue doing that. For those of you who are just joining us, welcome to the 8th Annual Hispanic Heritage Foundation Investors Forum. We want to thank again our sponsor, TIAA Institute, for their continued support. And up next, we have the CIO Asset Allocation Roundtable panel. Joining the panel, we have senior institutional investment officers who will discuss their approaches to asset allocation and risk management in light of institutional constraints. Moderating the panel, we have Stacy Olivares, board member of CalPERS. Stacy, thank you for joining us. All good. Yes.
Oh, wonderful. Well, thank you all for being here today. Thank you to TIA, Hispanic Heritage Foundation, and to the wonderful panelists, Rodrigo, Al, and Rodney. So excited to have you here today. So many questions right now about a post-pandemic recovery and asset allocation. So I think there's a lot of people tuning in to hear your thoughts. I'm going to give a little intro on myself, and then I'd love for each of you to introduce yourselves. Stacy Olivares, I'm a trustee of CalPERS, been a chief investment officer, and have been in the investment arena for many years now. We'll leave it at that. And I think there have been a lot of developments in this space over the past few years, and we're starting to look more at things like ALM and other types of liability management strategies, different ways of allocating our portfolios. So with that, I would like to first ask Rodrigo Garcia to introduce himself.
Awesome. Thank you, Stacy. It's a pleasure to be here this morning or afternoon, depending on where you're at in the world. My name is Rodrigo Garcia. I'm the Deputy State Treasurer and Chief Investment Officer for the Illinois State Treasury. In this role, I oversee about 40 billion or so across 7 different investment portfolios, some fiduciary, some non-fiduciary, some with various investment objectives compared to others. So definitely some internally managed, some externally managed. So it definitely keeps the role quite interesting and from a day-to-day perspective. In addition to that, I do sit on 4 investment committees for various endowments and foundations here in the city of Chicago. And then lastly, when I do find the time, I am also a finance professor at Northwestern University. With that, pleasure to be here and look forward to a thoughtful conversation with my fellow colleagues. With that, I pass on the floor over to Al.
Perfect. Al Hemmingson, the Chief Investment Officer of Parkland Management. So I think I'm in the position of being by far the smallest investor on this panel. Parkland is a family office. We're based in Cleveland. It's been around about 30 years, primarily focused on hedge funds and private equity. And I think it'll be a fun discussion as we have very different portfolios, very different constituents, very different sizes, resources, and strategy around what we try to do and what makes sense for all of us. So look forward to the conversation.
Thank you so much, Al. Rodney?
Okay, thank you very much. It's so good to see all of you, and I want to thank the Hispanic Heritage Foundation for inviting me to speak today. So again, my name is Rod June. I'm the Chief Investment Officer at LACERS, which is the LA City Employees Retirement System. We're a $22 billion defined benefit plan that service the civilian employees of the city of Los Angeles. We operate a very diversified portfolio. Oftentimes I think of it as being not much different than other public pension plans. Obviously, we have to have a sort of an all-weather portfolio to allow us to perform well under all different conditions, including even the pandemic that we just came out of. We all suffered some unrealized losses going into that situation, but staying the course and not making any knee-jerk reactions allowed us to recover the $4 billion loss that we realized in that first several months of the pandemic. But that all came back, and we went from 19.4 billion down to 15.4 billion or 15.1 billion, and now we're at about 22.5 billion. So sticking the course is very, very important for us. And I hope to be able to share some of my insights later on in this presentation. Stacy, I'll turn it back over to you.
And I'm going to turn it back over to you, Rodney. I'd like to start with you on how you approach asset allocation. So pensions obviously have very long-term liabilities, and those are very significant. And we're seeing life expectancy increase. How does that inform your approach to asset allocation?
Yeah, that's a good question. So asset allocation, obviously we have heard, is one of the most important decisions that boards have to make. So I am keenly involved with that asset allocation process. We just came out of an asset allocation exercise over the last several months, and the board at Lacers made a decision to pretty much kind of stay the course that we had been taking. We still have to have some growth opportunities in there, so we have equity exposure, both on the public side as well as private equity. I will say that we even increased our private equity allocation from 14% to 16%. So a 2% bump up there, recognizing that we're an underfunded plan. We're just a little, I think, under 70%. We have a ways to go, so we need that growth element. But we also recognize that we have to pay benefits. And so we also look for investments that have stability. So we have, obviously a core fixed income allocation, as well as what we call credit opportunities. And these provide sort of a steady stream of income to the plan. We're also in TIPS strategies to account for inflation, but it also functions a lot like fixed income. Recognizing that there could be inflation in the future, we do have a real assets allocation. So we didn't increase that much. We do think that the inflation concerns are more short-term because of the pandemic situation, but we have our assets invested there as well. The asset allocation decision, it's obviously very tough. It can be a lot of discussion from board members, input from staff, the general consultant. A lot of it comes down to, do you believe the capital market assumptions that are being presented to you? How reliable are they? And for some board members, it was a little tough. I know the research that our consultant does when they bring us the capital market assumptions is, based on a lot of studies, looking at what other consultants are doing, looking at the economic future, market conditions, et cetera. Ultimately, I think our board got comfortable with that. And then the asset allocation that was approved, I think positions us well to ultimately get fully funded status within a little over, I think, around 20 years or so. I know that's a very long distance out there, but we think in terms of very long-term time horizons at Lacers, and as do most public pension plans. And so, we're not here to be tactical investors per se, although staff does have certain tools available to them. But we pretty much like to stay the course because we've got to pay out well over $1 billion of benefits a year to about got about 18,000 retirees, between 14,000 and 18,000 retirees. And we still have a lot of active members that we have to pay out to. So those are all considerations. We want to ensure that we have sustainability going forward in so many different ways. And I think we'll be touching on that when we talk about ESG in a little bit. But that's our approach. It's somewhat of a conventional standard asset allocation approach, but there's a lot of discussion that goes behind that.
So just to follow up on that, Rodney, one note. So for those watching, TIPS, Treasury, inflation protected securities, there are going to be a lot of acronyms going back and forth. So I'll try to do my best. If anybody has a question, please go ahead and put it in the chat or the Q&A. Rodney, so you mentioned increasing the private equity allocation of Lacers from 14 to 16%. Is that correct?
That's right. So private equity has been the best performing asset class at Lacers over longer periods of time. Granted, it has its moments where it doesn't do quite as well. But I would say, those are really more individual partnerships that have a lot of volatility in it. If you look at the asset class as a whole, and we have $2.7 billion market value in private equity, it tends to hold its value fairly stable compared to the public markets. Because it is the highest returning asset class that we have over long periods of time, and because we're underfunded, our board, I think, had concern that we get to a fully funded status within a reasonable period of time. And the one way to do that is to put a little bit more weighting towards growth assets. And I think private equity, for as complex as it can be, our board members have received a lot of education in that area. I think they understand how private equity works. And so the board, I think, was fairly comfortable going from 14% to 16%. Now, granted, there are the challenges of trying to get to that target. Since private equity has done well, we've received a lot of distributions over the past few years, and we're trying to put out about $700 million a year in private equity commitments. It's sort of been like being on the hamster wheel, right? Mm-hmm. You keep running and you don't seem to get anywhere. We had a pretty frank and honest discussion with our private equity consultant that they're going to really have to find ways to get us larger commitments with the best partnerships out there, and also to increase the universe that we look at. We talk a lot about diversity, right? And we know that there are missed opportunities out there because, let's face it, every consultant and every business has sort of their sweet spot that they look at. We're asking our consultants to go out on a limb and stretch and really find more investment managers. And by and large, that includes the emerging manager space, because we know that's an underserved area. It's not looked at enough. I spend a lot of my time as CIO canvassing the marketplace for emerging managers to ensure that we give an opportunity to every qualified manager that's out there, particularly with the emerging managers, because the research has shown that emerging managers, these are smaller managers, usually like in private equity, it'd be a first-time or second-time fund, or on the public market side, it's firms that have $2 billion of AUM or less. They tend to perform slightly better than the larger firms. But we also recognize that there's also more due diligence and a little bit more homework we have to do, but we're willing to do that at Lacers. And we have a very strong emerging manager program here with a very good policy, and I'd be happy to talk about that later. But we did that increase up to 16%, and I think we'll do well over longer periods of time with it.
Interesting. So increasing your risk-adjusted returns by casting a broader net and increasing your private equity allocation.
Right.
Like it. Al, what about you? So you're in a little bit of a different situation as CIO of a family office. So maybe not really managing to liabilities, but trying to get the best returns possible as the fiduciary for that fund. Can you walk us through your approach to asset allocation?
Sure. So while we don't face an explicit liability or a payout rate that goes out every year, we do have family members that are supported under our umbrella, and we also administer a number of foundations under our umbrella. And those foundations do have gift rates or distribution rates that they aspire to every year. So in some ways, it resembles an endowment. So in terms of asset allocation, it's a growth mindset. A meaningful portion of the assets are taxable, so we're attentive to after fee, after tax returns. That pushes us into areas such as private equity or private capital generally. It pushes us out of areas like traditional fixed income. So we hold about 2 to 3 years of reserves, distribution reserves and spending reserves in cash, and that's in short-term treasuries, nothing else. And then aside from that, there are no fixed income holdings. We're a smaller organization, as I alluded to, so we're constantly attentive to the resources required to execute on certain strategies and what we have at our disposal. So within public equities, we index nearly all of the developed world above a certain market cap. We have certain relationships that are active. When I say active trying to buy exchange listed stocks, in different countries. So for the most part, we index the US, we index Europe in mid and large cap. We have active management in smaller cap markets outside the US primarily. And most of our time is spent on our private equity and hedge fund portfolios, because that's where I think we can drive tax efficiency, and we can also drive value added relative to our efforts trying to increase returns there. So about a quarter of our assets are private equity, about a quarter of our assets are hedge funds. And because we're small, part of our strategy is intentionally skewing towards smaller funds and smaller managers themselves. So just as a frame of reference, we've committed to 8 private equity funds this year. They range between 100 million and 1.2 billion. And most of the time they're in that 500 million or below space. And that's a similar pattern you would find in the hedge fund portfolio.
It's quite the spectrum. When it comes to tax advantaged investments, are you looking at things like new markets tax credits or other types of investments that have some type of positive social impact, but also some type of tax benefit?
So there is an ethos that the family is becoming increasingly clear about articulating. So part of that, for example, the principals in our family care deeply about climate change, and that's the strategy around carbon and how we're going to invest around it and report it and measure it has become more precise over time. We're in process of getting more precise around diversity and inclusion and what we do there. Mm-hmm. We've looked at certain tax advantage and opportunities that also have an impact angle. So the last one was opportunity zones. Just to very quickly level set the audience, the Opportunity Zone program was created a few years ago, and basically the proposition was if you sell appreciated stocks and you're going to pay a large tax bill, you can defer paying the tax if you take the proceeds and you invest in a economically disadvantaged area. And basically the idea is that you have to, not just buy something that exists, but you have to develop something or basically improve the real estate in that area. And if you do that and you live up to your obligations, you get certain tax benefits. We've looked at things like those in the past. We do a little bit of it. In that case, it actually wasn't actionable for us just based on the math at the time of what the tax benefit actually looked like for us. But we can and will do that from time to time.
Interesting. And how do you see your asset allocation changing over time?
For the most part, it's been stable. I think investors go back and forth. For family offices, generally hold a lot of cash. That's fairly typical. Mm-hmm. You can kind of go back and forth on this idea of, are you willing to just sit there and earn functionally zero on your money, on that portion of your money forever, until you need to use it. There are other things that you can do with cash or cash-like stuff. You can do shorter term bonds, you can do credit instruments, you can do private lending. There are a variety of things that you can do. But I think in terms of the governance of it, once you do that, you tend to worry about your ability to access that cash at the moment of truth. Mm-hmm. So in 2008, people were creative about their cash, trying to get incremental yield. And then depending on what you were doing, you could have been locked out of being able to actually use that cash when you needed it most. So for the most part, we've opted for the decision of it's going to sit in basically zero returning treasuries because we know we can access it at the moment of truth. We've kind of gone back and forth debating that. Private equity continues to grow. It's like in Rodney's situation, our assets have done well. We've gotten some distributions back, but valuations seem to consistently grow on us. So it's an open question for us as to how we manage around that, or how we think about that going forward.
Great, thank you. Rodrigo, you have quite the broad portfolio as Deputy Treasurer for Illinois, and you're over the pension, you're over many different things. Can you walk us through that and how you approach asset allocation differently for each of those areas?
Yeah, most definitely. If anything, I would say it's interesting to be able to evaluate asset allocation across a number of portfolios because instead of just running one asset allocation, I'm running multiple asset allocations at any given time. And given that we utilize different investment consultants for different portfolios, I also then get to evaluate how consultants are evaluating their asset allocation models, their various methodologies, their capital markets assumptions, and so forth. So it definitely brings to light a number of different views and different perspectives. And given that we have different investment objectives for each of these respective portfolios, each of the proposed asset allocations are approached differently. Now, with that said, I would tell you that we don't just look, I'm assuming just like everyone else, we don't just look at the broad asset allocation and the asset classes, but we even look at sub-allocations and sub-asset classes to ensure that our asset allocation not only is optimized for manager selection, but is also optimized based on the degrees where we feel, the markets are moving, not necessarily in the next year, but in the next 20, 25, 30, 35 years. And so as probably many of you who are listening, we across many of our portfolios have long-term views. So when we are making some of these adjustments to our allocation, we're not just necessarily doing it for the next year or 5 years. We're doing it for the next 20, 25, 30, all the way out to 50 years. So we very much take an approach from a strategic asset allocation, not necessarily one of a tactical allocation. Now, we may make tweaks on an ongoing basis, but they're not necessarily being done in response to what's happening in the markets, but rather how capital market assumptions and other parts of the financial markets are changing, and therefore we're making those tweaks on an ongoing basis. If anything, what we try to do and take advantage of is our opportunistic investments, things like venturing into areas that maybe other folks may not necessarily be as comfortable, and maybe because we have the resources, we can do that. Things like co-investments, where we're doing more direct exposure to companies. Things like venture capital, especially even in micro venture capital, which we're definitely venturing into. Things like GP stakes and taking stakes and seeding new investment funds. And so it's just a very interesting time right now, because not only are we seeing longer life expectancies, as you mentioned early on, but we're also seeing changes in the financial markets in terms of assumed rates of return. And the interest rate environment is obviously changing, not just in the last year, but even before that. Really, since 2009, we've had a very low interest rate environment. And then you throw in other aspects such as ESG and its impact over the next 10, 20, 30, 40 years. And now you have a number of things you should keep into consideration as you're evaluating your asset allocation for each respective portfolio. And the last piece I would mention is that one of the things that has been very helpful in our approach is that it's not one of those things where you set it and forget it. We're constantly evaluating the performance of each of the asset classes to the benchmark and our capital markets assumptions to make sure that that we're not only that we're back testing our own assumptions, even in the going in the rearview mirror, to ensure that the assumptions that we're making on a year-to-year basis going forward are at least founded not just based on historical component, but even in our own assumptions, right, and our own perspectives for our investment team, to ensure that we're not also have any blind spots or not being influenced by our own biases. So that's a general kind of process, which is pretty traditional, I would say, and it's pretty plain vanilla in many ways, but also different in other ways.
Talk to me a little bit about what you do on the Treasury side, because I've seen some changes there. I know in California, we have a program called Qualified Custodian, and it's a way to increase capitalization of minority-owned banks that have $750 million in assets under management, for example, or on deposit. Are you looking at different ways to maintain that stability, liquidity, get a little bit of yield, because interest rates are so low, and try to reinvest within the state?
Yeah, that's a great question. So one of the portfolios is the Treasury portfolio, and in that way, we are providing some of that. And one of the I guess benefits of being able to do this is you are able to make an impact and still be able to draw, even if it's we'll say a nominal rate of return by placing money in some of these institutions. Now, we don't do it willy-nilly, because I could probably, I shouldn't say me myself, but my team can easily get a much better rate, even in the low rate environment, through any number of potential opportunities out there, than just placing money with a financial institution. But in this case, if they are providing a certain level of impact, especially in many underrepresented, underserved, and underinvested communities, specifically the African American community, the Latino community, and or even parts of rural Illinois, which have been have been subject to the I will say the impact of globalization and the impact of innovation and automation. And so in those cases, we definitely will invest. And if anything, we just started not only placing just plain vanilla deposits, but we've started now investing directly into the equity stack, meaning into their tier one and total capital basis for many CDFIs and MDIs, because not only do we want to just earn a nominal rate, but now we want to be able to expand their economic activity into various aspects of the state, but even more so be able to then receive both bond-like and equity-like type of returns by being a shareholder directly into these institutions, therefore promulgating a economic activity, but even more so investment returns, especially given the amount of resources that are being afforded to these type of institutions. It's a win-win for both the financial institution and for us going into the ensuing several years.
Thank you for that. And for those watching, CDFIs are community development financial institutions. They have a local, typically, mission of having a positive social or environmental impact and are certified by the Treasury Department. I would like to get on to the post-pandemic economic recovery. There is a lot of interest in that topic, particularly in what we can expect for an economic outlook. You three are experts in this space in terms of capital markets and the investment horizon. Al, let's start with you. What do you see over the next 3 years as vaccination rates increase and the rates of COVID decrease?
I guess in terms of the most meaningful parts of it, I have no idea, and I will be curious what the others think on this. In the near term, you can see vaccination rates continue to increase, and regardless of where they peak out, the world's going to reopen. And in parts of the country, we're based in Ohio, and Ohio isn't quite Florida, but it's been pretty open here. You have a reopening that's going to happen across the country. You have people that have been basically in their homes or unlimited mobility for about a year, and then combine that with stimulus programs. And there's some interesting data sets. You can see that the average consumer hasn't really spent the stimulus. A lot of stimulus payments have gone to pay down debt, and they're sitting on relatively high levels of cash relative to history. I think we have a relatively strong belief that economic activity is going to pick up. People are going to travel, people are going to restaurants and bars, people have excess spending capacity, wages are growing, or wages are going up for a variety of different reasons. Employers are finding it hard to fill positions. How you translate that into investment activity gets much more complicated because prices have gone up in markets. So prices are anticipating that, and we go back and forth in this debate of, have they gone up too much, too little, because it's going to be another case of the roaring 20s, like 1920s, or our thing is fairly priced, and markets have kind of more smartly than any of us figured out what the next few years are going to look like. So in terms of trying to figure that out, I don't think we have a whole lot of anything revelatory to add. We generally believe that credit conditions are less attractive. So what I mean by that is in 2020, in early 2020, during the depths of COVID, as a family office, one of the advantages you have is extreme agility. So we were able to make a few opportunistic investments in the credit area, distressed companies that needed capital and they needed it now. We were able to do that kind of in April and May. And by June, it'd become much harder for us to do that stuff. Just conditions had come in, government assistance and various programs had kicked in. So companies were able to persevere without, going to certain funds or certain credit funds who demand really onerous terms. So we've been doing very little in credit since then. The way our private capital book is set up is it's basically one big pot. So it's a little bit different from how some other institutions might operate it, where you have venture capital, buyout, credit, et cetera. You have different buckets. For us, we think of it as one big pool of long-lived capital, and at any point in time, opportunities compete with each other for an allocation. So a buyout fund has to stand up relative to a venture fund, and as I alluded to, sometimes credit is attractive enough for us to do, and sometimes it's not, and we won't do it. So that's how we tend to do it. Within venture, as a family office, we are challenged, I think, to get access to kind of the top venture managers that everyone else aspires to get access to if you don't have those relationships already. So again, a lot of the time we will do relatively little in venture, but post-COVID, we are a family office that is not a university endowment, and universities were all closed. They had sent the kids home. They're frantically worrying about expenses, and they're not in a position to act quickly on the next venture capital fund. So in 2020, we had a few conversations that with funds that I think in ordinary states of the world, they wouldn't have needed or really cared to talk to the likes of us, but we had capital and they were still open, and we were able to do some things there. And today that window is closed now effectively for us. The world seems very normal. So at this point, I would say that's what we've done, and we're trying to figure out where we go next.
Great, thank you, Al. Rodney?
Yeah, I think Al did a very good job at sort of describing the outlook and sort of the sentiment that exists out there. I think, in my role as a CIO, I kind of share the same thing. I would say, being a fairly large public pension plan with $22 billion in assets, we continue to invest. When we look at the markets, I think it's going to be somewhat uncertain out there. We're coming out of a very unusual situation with the pandemic. We've not gone through this in a decade, a century, right? We're not really sure how things are going to play out. And times are different now than they were, 100 years ago after the Spanish flu. I would say that as a CIO, I'm probably a little bit more guarded in anything that we might look at strategically. I think it's somewhat of a kind of a wait and see situation. I can't say that Lacers is truly cutting edge like many public pension plans of our size. We tend to kind of look and assess the marketplace, the landscape, the economic indicators, and then we kind of follow in place. I'm not saying that's necessarily the right way to do it, but that has sort of been the convention that's been shared by many of us. Look, we're looking at a possibility of increased inflation out there. I think as June Kim had spoke about earlier today on the panel, is this something more of a temporary blip, or is this sort of a long-term proposition? I tend to think, that it's probably, we're going to see inflation being a little bit high in the short term, but I think there'll be some sort of equalization or some equilibrium that will play out where inflation will, I think rise over time, but I don't think it's going to be, leaps and bounds type of inflation increase. Still, that has, concern for us because, inflation impacts the investment markets. Also coupled with that are, interest rates rising. I think we've seen some rise in those rates. They've kind of come back, but we've come down so low. It seems like there's nowhere else to go but up going forward, and that certainly has implications for the total economy, and then ultimately how it plays out in our investments. I want to, also say that because we are a large investor, many of the sentiments about inflation, interest rates have had their discussion time when we did the asset allocation exercise over the last several months. And those viewpoints, whether they're really going to play out the way we think they are or whether they don't, it's baked into that asset allocation. So as I mentioned earlier, we don't do tactical investing. We decide on a strategic approach. It's manifested in how we allocate our assets to public equities, private equity, real assets, various fixed income strategies. And then we let that play out over 3 years. We will do our next asset allocation exercise in 2024, and we'll see if things have changed. But I think for now, we do still need to, we're still looking for growth. I think there is still a growth play, certainly in the US public market space. In certain sectors, I don't think it's kind of a widespread across the board where everything's going to do well, but I think there are certain sectors that will do well. We've seen some bump up in the hospitality area and travel, transportation, for example. It's tough. It's a tough call right now because of the pandemic. It's really influenced and impacted so much of what we typically do from year to year. And so, like I said, I think we'll take somewhat of a guarded approach, and we'll continue to invest strategically the way that our asset allocation has been decided on by our board.
Thank you, Rodney. Rodrigo?
Yeah, so great comments from fellow colleagues here on this panel. Look, at the end of the day, we're not going to be doing anything too tactical. We're very much strategic. So we're going to do many of the things that have kept us on top, which is asset allocation. It will always be driven by asset allocation. We may make tweaks along the way, but ultimately we're going to stay true to our intended purpose. From there, we're going to be as rigorous as we usually are when not only continuing to do stewardship for our current managers, but also diligence on our prospective managers. So we're always, continuing to ensure that many of, not only performance, but their strategy, their thesis, their teams, and everything that goes into the investment process continues to stay on top in light of the change and evolving marketplace. We're going to continue to be aggressive on fees wherever we can and across the board. And if that means we take some of these pieces internally, that means we take it internally. So we're going to continue to do that. We do about 50%, broadly speaking, across the board, about 50% of our portfolio is passive and about 50% is active. So we're not necessarily on, one side or the other. We're at this point, we're pretty much middle of the road. It's really more, it depends much more on the asset class that will influence whether we're more active or more passive. We're going to still continue to have our strong, governance process. Not just checking in on managers when they're doing bad, but have a very structured approach in terms of how we're carrying out many of our investment duties, not just in our policies, but in our processes and in our follow-up. And then from there, we'll continue to do opportunistic investment to take advantage of what's happening. I think as has been very clear here is that it seems to be that there is a lot of money flowing into alternatives, whether it's private equity, whether it's private credit, whether it's venture capital, whether it's real estate, whether it's infrastructure. That is where a lot of the opportunities are. But whenever you have a plethora of money coming in, you have to make sure that that there's still a certain quality assurance, a certain quality threshold that is being met, and that our due diligence is not necessarily softened or minimized or lowered just because of the amount of money that's flowing into the sector. If anything, we should be much more attuned to some of the risks that may lie by having, so much amount of money in, pouring in this area. With that, I would mention two areas that are interesting. On one side is the low rate environment. I'm talking about like the short end of the curve. We're talking about repo rates and short-term rates that are really going to, put the Fed into a very interesting position over the next several weeks and months because there's so much cash in the system right now. And with the federal government about to send a couple hundred more billion to state and local governments, we're going to see, the money market, spectrum of the fixed income investment spectrum really continue to be challenged. And so that's one piece. Now there's things that you can do, municipal bonds are the great way. There's bank loans, even high yield, depending on your exposure already. And then the second piece is around valuations, because valuations can be done in a couple of different ways. Many of the numbers that I see were, car lots that are set, that are seeing, vehicles on the lot for 1 to 2 days before they're being sold. So you have consumers that are obviously buying. We're seeing not only residential sales, but even residential real estate, like just for rentals. We're seeing pent up demand that we've never seen. Many of our managers are seeing for when a apartment goes on the market, 100 to 150 people applying for one apartment. And so where in typical normal cycles, you would see like 30. And so we're seeing pent up demand around technology, around leisure and entertainment, around transportation, as Rob was to. But on the flip side, we're also seeing continued, friction in areas such as office space and even consumer staples. As people go out, they're not as in favor as they were just last year when we were in the middle of a pandemic. Even on the private side, we're seeing increased evaluations going all the way down to even in venture capital. Many of our co-investments in Series B, C's, and D's are getting all marked up 3, 4, 5, 6 times, and so we're seeing both the benefit of it, but also seeing that it's not necessarily going to be all rainbows and sunshine going into the next several months and years. And that's why we have to stay strategic in our approach and continue to rely on the investment fundamentals that have worked for us for so long.
Great, thank you. So I'm going to take one question because we just have a couple minutes left. And Al, we're going to start with you since you've already mentioned this. Private credit. So we have a question about current private credit allocations and thoughts on this space over the next few years.
Okay. Current private credit allocations. Got it. Okay. So our current private credit allocation is pretty small. I don't have it at hand, but it's going to be 3-4% of assets, if that. Generally, as I alluded to, most of the time we don't do a lot. And then occasionally at points in time, we will do a lot of it. I'm a pessimist, even without sort of the tax thresholds and other things that make it harder for family office. I'm generally a pessimist on private credit. And maybe kind of the one anecdote I'll give is if you talk to your private equity firms, your buyout firms, and ask them in detail kind of how they select their financing providers for their funds. Basically, they maintain a panel of 6 or 7 lenders. And it's still genteel. It's not completely aggressive, beat them over the head, but for the most part, it sounds a lot like beating them over the head in terms of the ones that are going to deliver capital to you fast, simple, cheap. They win the deals for those loans. And if you keep coming back to the table and playing nice, you get to stay on the panel, and if you don't, they'll replace you on the panel. It very much feels like a commodity service in many ways when we've looked at it. So we don't do any middle market direct lending. When we do credit, it'll be portfolios of non-performing loans that we think can be bought cheaply. It'll be distressed type of stuff. It'll be much different stuff than kind of traditional middle market.
Yeah,
Great, thank you.
I'll address that at Lacers. We have a 3.7, we had a 3.7% target allocation to private credit. We had some challenges trying to get that capital out, and
Yeah.
I think we have some very good managers to assist us with that area. When we went through the asset allocation exercise, we increased that to 5.7%. So we're more bullish in private credit. I still have some reservations about it. I think a lot of it comes down to which investment manager, which private credit manager you hire. Really comes down to the manager selection and what their strategy is. And it's got to be the right fit strategy for you. You really just can't go out and pick anyone out there. So we think that that is an area that can serve us well for the long term at Lacers. We still, again, have to figure out, I think, the implementation plan for that additional. It's really more than 2% because we haven't allocated all the money from the 3.7%, but we are taking somewhat of a bullish approach, and we do think private credit is an attractive area for us.
I would agree with Rodney. We're in the same boat. I think it very much depends on the managers and their relationships to sponsors or non-sponsor deals. And thus far, many of our managers that we work with, Brightwood Capital to Vista Credit to a number of others, have performed pretty well for us. And even during the pandemic, when I thought they were going to have significant hardship, and they did, but I actually thought they performed much better than I thought they were going to perform, and be susceptible to a number of losses. And obviously they were buoyed by a number of economic stimulus that came forth in the ensuing months. But to date, we're still continuing to allocate. It just really for us, what matters more so than the asset class itself is their relationships to deal flow and how they're evaluating some of those deals that are coming along.
Great, thank you. Well, we are out of time. So Rodrigo, Rodney, Al, I want to thank each of you for providing your perspectives. To all those watching, I hope this gave you an inside look into how assets are allocated by CIOs. It requires a lot of thought and very long-term processes. Thank you very much.